Okay, good.
Good morning, everyone, and thank you for attending this meeting on this beautiful Wednesday. Today, we're going to talk about a subject very near and dear to my heart, which is about long-term care. And just to share my own personal story, and I know everyone has a story. Growing up, my father was like this incredible athlete. He was a semi-pro goalie in soccer. He was a veterinarian, very successful, played tennis every day from the time he was 21 till 65. Growing up, this guy was a beast. I mean, he was everything. He was strong, smart, educated, made a good living, everything to me. He was like my God. I mean, what can I say? All these years of tennis led to disintegrated discs in his neck and his back, to the point where prior to his final demise, he was virtually paralyzed. My mother, who was 7 years younger, had to take care of my dad. And the first long-term care sign was he was taking a bath and couldn't get out of the bathtub. So my mother's plan was, well, let me call 911. Well, 911 took 2 hours while he was sitting in the bathtub. Came, lifted him out. A week later, taking a bath again, couldn't get out. Well, 911, 3 hours. Well, anyhow, as time rode on, my mother was his caregiver, and it took its toll on her, and she passed away 7 years prior to him. Taking the car away, or the driving privileges away from my mother, who was driving my father around in a wheelchair at this point, where both sides of the van that they had purchased had dents along the sides. Thank God she never hit anybody. And taking her license away was one of those moments in life I won't forget, because I took away her independence. And then later on, when I was just there, looking after my father, I had the unfortunate thing of having to change his diaper. And let me tell you something. To see him look up at me and me look at him, and that it's one of those moments in life you never forget. Okay, so he was of the belief, as many of us are, I take care of myself, I'm doing well, it will never happen to me. Well, I hate to tell you folks, but the odds are today that 70% of all of us, that's 2 out of 3 of everybody on this call, is going to need some type of care. Now, the other 30% is going to have to take care of that 70%. So at the end of the day, we all need to address this issue. And we need to address this issue with our clients, because it's not just an emotional strain on people or children, who I always thought my daughter might take care of me, but she lives in Hawaii. I doubt that's going to happen. Okay. She has a life. It's not just an emotional strain. It is a financial strain. It is a tremendous financial strain. So any of you people that are financial advisors, I know we have financial advisors here and people who manage money. The biggest client retention situation, or attorneys, is when your client runs out of money because they need long-term care, and then you have no protection on the future generation. So there's 2 things that can happen if this is not addressed. Your clients can run out of money emotionally. However, if they're prepared and if they have the proper life insurance and long-term care insurance, okay, you do have a chance of perpetuating that money and maintaining the management of those funds with the future generations. But from an emotional and physical standpoint, this needs to be addressed with every client, every person you talk to. If not them, their parents. If not their parents, their kids. It's that big an issue. With all that being said, we all know we're in the midst of a pandemic. And the pandemic has brought on new strains on long-term care because we don't know the long-term effects of this terrible pandemic. We don't know how it's going to affect this long-term care. At the same time, we have a big shrinkage in product in the marketplace because the profitability of long-term care is not what they expected it to be from an insurance perspective, and we have extremely low interest rates. And why is that so? Well, just a little history in the long-term care market, and many of you know these statistics and everything else. When long-term care insurance first came out, I'd say about 30 plus years ago when I started in the business, the estimated cost of care was 1 out of 3 people were going to need long-term care. To go from 1 out of 3 to 2 out of 3 in that period of time is tremendous. The need is prevalent. That's number one. Secondly, the original long-term care policies built in tremendous inflation protection, 5% compounding, and they were giving lifetime benefits. The market didn't allow for that with interest rates and reserves. So now we have the situation that we're really down on the brokerage side to really one old school standalone carrier in the market of New York and maybe 2 or 3 outside. But the number one provider of long-term care insurance is here to speak today, and that's Lincoln Financial, the number one provider in the country, and they do it with a product called MoneyGuard. And today we're going to discuss all the innovative ways that MoneyGuard can be utilized with your clients to protect their assets. With no further ado, I give you Glenn Usher, who is the regional manager of MoneyGuard.
Neil, wonderful. Thank you so much for that. And I think that's a perfect intro. All of those things that you touched on, I think, a lot of times people will focus on just one element of what a long-term care event might do, right? So you're talking just about the finances, or you're talking just about what type of care might be needed. But I think we don't necessarily think about everything else that goes into not having a plan. So I do want to correct you on one thing. So Lincoln would be the number one insurer in long-term care if it wasn't for the federal government covering all of those claims through Medicaid, right? And that's ultimately what we want to talk about is, if you're putting a claim in Medicaid, and all of the folks on the line know, there are some serious spend down provisions before you can qualify for a program like that. That is that is the 911 phone call there, right? So what we want to talk about is long-term care planning, not just from a financial element, and I will talk on, what it's costing in the state of New York, but the whole Northeast are going to be pretty much in line with that. But all of the consequences of not having that conversation. So, a lot of times that conversation is not taking place for one reason or another. It's a taboo subject, even to talk about, our own mortality, let alone our own morbidity. So part of the reason why more people are going on claim is because they're living through the heart attack because of advancements in, medical technology and that sort of thing. So now you see an aging population, 1 out of 3 over the age of 85 will develop some cognitive impairment like Alzheimer's dementia. Oh, by the way, in the last 20 years, we've had far more people, turning 85, 90, 95 than we've ever had before. So it is sort of a perfect storm as far as the way that folks have changed and the way that they've aged. I think folks think, oh, I take care of myself. I'll never end up in a facility like that. Unfortunately, those that do take care of themselves, they're just as likely. They're just more likely to go on at an older age than somebody that doesn't necessarily take care of themselves. So I'm going to keep my comments relatively high level. So folks, that if you're familiar with the MoneyGuard name, or familiar with any of the competitors of Lincoln's MoneyGuard, our tagline for the last 30 years is that it's a smarter alternative to self-insuring, or a smarter alternative to self-funding. So I am going to talk about sort of the need for LTC planning. I think Neil did a great job at the top of the call kind of covering that. So I'm going to move through some of these slides quickly. I'm going to spend maybe 10, 15 minutes just talking about the MoneyGuard product and how it differs from some of the other solutions that are out there, because there are infinitely more solutions out there today than there was even 10 years ago. When you look at the life insurance products with chronic illness riders and long-term care riders, there's the standalone traditional LTC. Now we're seeing annuities with riders. So there's a number of different ways that we can talk about approaching the problem with these different solutions. So I'm going to talk high level on kind of what MoneyGuard is, and then really where it fits in the marketplace and the type of clients that we're having the conversation with. And then the meat of the call is going to be Mike Palatiello, who's going to be talking about a particular sales application in the business setting. So as I run through here, very quickly, I'm going to touch on those top two because we've already sort of talked about what some of them are. There's a taboo about having the conversation. It's really our responsibility to be engaging clients in this conversation, not necessarily to put, a long-term care insurance policy on the books, but to really start to drive that conversation around not just how are you going to pay for this event if and when it happens, but who in your family is going to be able to step up? What's the family dynamic? Are there kids living across the country? Is it going to fall on one relative? Are there relatives even in the area? So a number of different conversations that have to take place that are completely outside of how are we going to pay for it, and does an insurance policy make sense for us? But as I mentioned, the brunt of this is going to be on the options that are out there, specifically Lincoln's MoneyGuard product, who we're targeting from a demographic and that sort of thing. So very high level, what the IRS qualifies as a long-term care event is the inability to do two of those 6 activities that you see on your screen there. And those are, what I call the take for granted, right? Everybody wakes up every day, and if you're fortunate enough to have all of your mobility, you're doing most of those 6 activities in the first probably half hour of your day, right? You're getting up, you're getting out of bed, that's transferring, you're going down and making yourself breakfast, that's eating, you're going to use the restroom, hoping you get there on time without any accidents. So these are all sort of the things that most of us are doing in the first 15, 20 minutes of the day. By far the fastest growing claims on insurance carriers' books is the cognitive impairments. So the IRS definition of a long-term care event is the inability to do 2 of those 6 ADLs that you're seeing on the screen, or it's a severe cognitive impairment, which is rendering you basically unable to look after yourself. So you need substantial supervision to ensure that you're not hurting yourself, that you're not getting into the car and driving somewhere, and that sort of thing. Most folks, particularly clients, when you bring up the word long-term care, what's the first thing that pops into your mind? For most people, it's thinking of somebody the last stage of their life in a nursing home. Nursing homes actually only represent about 10% of the active long-term care claims, which means the other 90% of that care is being provided in, 50% or so is provided in-home, and then there's about 30% in assisted living facilities, and then another 10% in adult daycare and that type of thing. So I think that's another thing that's really changed over the last 20 or 30 years is how the care is actually being delivered. There used to be long-term care insurance policies, and all they covered was nursing home. So, while the care delivery methods have changed, so too have the insurance policies. So when you're talking about a qualified long-term care policy today, you are talking about a policy that really covers the whole gamut from as soon as you receive that Alzheimer's diagnosis all the way up to that, full-scale nursing facility. So it covers a wide array of services. When you talk about the costs, so this is kind of where the conversation, the rubber hits the road, right? So the conversation should really be about the family dynamic, who's going to step up, are there kids going to be involved? What type of care facilities might you want to go into? Most folks probably want to remain in home. So how do we do that as long as possible? But ultimately, when that long-term care event comes, there's going to be a significant cost. And I think most folks drastically underestimate how much that might be. So you see that first number there, that's the full scale private room in a nursing home. So that's that 10% of clients that are actually receiving care in a nursing home. Almost $150,000 a year, and that's on the average. Most of the folks that we're having conversations with probably don't want to stay in an average nursing facility. They want to stay in something a little bit nicer. So all the numbers when we're talking about averages is just a good ballpark number to say, hey, if we're engaging this client in a conversation, maybe that's a good starting point as far as how much we want to cover from a long-term care event. So that's on an annual basis. I typically talk about long-term care as a hedge, right? So most folks don't fully insure what a nursing home might cost because that's just going to be cost prohibitive. But I always talk about it as a 50% hedge. And I do that because, in most states, the assisted living facility is going to cost about half of what a full-scale nursing facility costs. So if we have the conversation, say, well, let's put a 50% hedge against that higher end cost. We know that that's going to be a pretty good hedge against assisted living facility and home care facility. And frankly, where most folks end up, receiving the brunt of their care. So that's about $70,000 a year in the state of New York. And then you talk about the hourly rate for a certified home health aide. I caution that number is probably low because folks typically look at it as a 40-hour work week. But anybody that's been through a long-term care event knows that it's not just 40 hours a week, right? There's either a family member chipping in or there's somebody coming out to the house. You might need a registered nurse versus a home health aide. So those costs are typically underestimated as well. So we know the cost. We know that it could potentially cost about $150,000 a year in today's dollars. We know that most likely it'll cost around at least $70,000 a year for that home health or for that assisted living. So what options do we have as far as actually covering what those costs are? Starting on the left, Medicare will cover a very, very short component of a long-term care claim. Medicare will only cover what's deemed medically necessary. And if you look at the triggers for a long-term care claim, those are all, not necessarily medical related. Those are all about mobility, right? So Medicare might cover, but it's got to be preceded by a hospital visit. So very, very restricted as far as what you can put in a claim for Medicare. Medicaid, as we talked on, is available, but requires basically that somebody spends through all of their own assets first. They have to sell their home or they take the reverse mortgage. Ultimately, that is the 911 call. I spent through all of my assets. I need help. Then you can put a claim in with Medicaid. Family is also probably the number 2 unpaid caregiver, and families have to basically step up and take care in the absence of a formalized plan or in the absence of a long-term care policy where you can actually hire qualified help at a significantly reduced cost. Now, the last two here, traditional LTC insurance, I'll talk on the next slide, and hybrid LTC like Lincoln's MoneyGuard is a hybrid or linked benefit product. So I will touch on both of these on this slide here because, as I mentioned, there are far more options now than there ever have been as far as how do we cover this potential long-term care event. I even lumped self-funding into it. So if we start on the left, those are the plans that I think from a flexibility standpoint, not necessarily the highest from a long-term care leverage standpoint, but might offer a little bit more flexibility. Then if you fan all the way over to the right, those are going to be your best leveraged products as far as bang for your buck as it relates to long-term care. And then those hybrid solutions that are in the middle are providing some level of long-term care and some level of other planning options, whether it's income planning with an annuity, death benefit or legacy planning with the death benefit, or hybrid MoneyGuard products are going to be more leveraged for the long-term care, but do have that death benefit component to them. So that's not to say that any of these solutions are better than another. It really comes back to what is the client looking for. If they're looking for a bigger death benefit, they're probably going to be better suited with a life insurance policy, and then the LTC rider is just ancillary to that. If they're looking for, I need to minimize my annual outlay, and I'm not concerned about legacy planning or guarantees, the traditional LTC product all the way on the right might make the most sense. But what we've found at Lincoln over the last 30 years are most folks want to be more leveraged for long-term care if that's the goal, but they don't like the aspect of, my premiums could go up in the future, or if I never have a long-term care event, I get nothing out of this policy. And that's really where Lincoln's MoneyGuard product fits. It is a long-term care first product, but does provide guarantees and does provide death benefit if the long-term care is never needed. So on this slide, that's showing exactly what I just mentioned. So the story with MoneyGuard, it used to be the 3 L's: leverage, legacy, and liquidity. The first L is leverage for long-term care in a tax-efficient manner, meaning any benefits paid from the policy are paid tax-free. If you never need the long-term care, you're always guaranteed to get a death benefit. So that's your second L, the legacy piece. That's always going to be paid tax-free to your beneficiaries. And then that last piggy bank there is the third L, which is the liquidity bucket, our return of premium benefits. So with this policy, you can pay and get a basic return of premium, which is a 70% option, meaning if you want to cut and run in 10, 15 years, you're always guaranteed that you can have at least 70% of what you paid into that policy guaranteed as a surrender value. Or the vested option is 100% return of premium option. That's on a 10-year vesting schedule. But after 10 years, if you want to get out of that contract for whatever reason, you have change in financial circumstances, you find something better on the open market, you can surrender and get 100% of the premiums paid back that you had gotten into it. So I think that third bucket there is a nice feature. In Lincoln's history, less than 1% of folks ever actually surrender these contracts because, frankly, when they got into them, interest rates were good. The leverage with these products was extremely good. But lapse ratios on long-term care insurance across the board is virtually nothing. Once folks get into long-term care contracts, they typically stay into them, especially if it's a truly guaranteed contract. So that piggy bank to the left and that one in the middle, that's really where we've grown up with Lincoln's MoneyGuard. We have the leverage on a tax efficient basis for long-term care if a client needs it, and a death benefit that'll go back to their beneficiaries in a tax efficient manner if they never need the long-term care. So just a quick example here. This is Susan, she's 58. She is married, which is important because in all 50 states, we do offer a marital discount, even if only one client is applying for a policy. So as long as they're a member of a married couple, and that does apply to same-sex marriage, common law marriage, and things like that. In this case, she's purchasing a $100,000 MoneyGuard policy. So I always caution, we shouldn't necessarily talk in terms of premiums, because most folks, as soon as they hear the word premium, they're thinking of their car insurance premiums, their medical insurance premiums, and those are the types of policies where you pay a premium, and if you never actually file a claim, you get nothing out of it. So I always talk about these as either a deposit, so a deposit of $100,000, or she makes annual contributions of $10,000 a year over 10 years. Talking about it in slightly different terms than I think folks are looking to hear about, because this is an asset-based solution. We can talk in those terms because we know that the client's guaranteed to get something out of it. This is not the typical use it or lose it proposition. So in this quick example, the two return of premium options are going to be those two rows there. So these are two separate policies, two different options that this client has if she wants to fund with a $100,000 single deposit. So with the basic return of premium option, that's where most folks go, because that's the biggest leverage point for long-term care and death benefit. So for $100,000, if she repositions that, say, from a maturing CD or from her savings account, moves it into this policy, immediately it's leveraged to that $482,000 LTC number. So she makes $100,000 turn into $480,000 on a tax-free basis if she never needs long-term care. If she needs long-term care, if she never needs the long-term care, you get the second piggy bank. You see the death benefits $160,000, and then of course her return of premium is the 70% option. If you look at the next row down, that's the vested option. So if she wants the full liquidity with this policy, you get your $100,000 return of premium benefit. You do see slightly less LTC leverage there, right? So $400,000 in that case, if she ever had that long-term care event, versus the death benefit with that policy, which is $134,000. So those are the two options if this client wants to fund it as a single deposit. Ultimately, you're getting almost 5 times leverage on the asset for the basic, and 4 times leverage on the asset if you want the 100% return of premium option. So this is very similar, same exact client. Instead of funding it as a single deposit of $100,000, so just moving from her left pocket to her right pocket to get the leverage and the death benefit. In this case, she's taking the same $100,000, but she's funding it over 10 years. So making annual contributions each year over the course of 10 years. The exact same value proposition, all the benefits, all the LTC, everything is fully guaranteed. But you are going to see slightly less leverage because you're funding it over a longer time horizon. But I've said the word guaranteed a lot. I think a lot of times folks kind of don't necessarily focus on that. When you're talking about a true long-term care product, especially when you're talking about the value prop against the standalone traditional long-term care policy, I think if anybody's read an article in the last 10 or so years about long-term care insurance, 9 times out of 10 it's about this insurer's filing rate increases for, folks that live in this state, right? And it's usually 50, 60, 70% rate increases when frankly, a lot of folks are on fixed incomes, right? They bought these policies 10, 15 years ago. Now all of a sudden their premiums are skyrocketing to maintain that same coverage. The death benefit is a big part of the MoneyGuard story, but the fact that all benefits and LTC and death benefit are guaranteed with MoneyGuard gives folks, a really good peace of mind that, they're not going to show up in one of those articles about how all of a sudden they're, Lincoln's asking them to pay a lot more in premiums. Lincoln's MoneyGuard is a fully guaranteed solution with long-term care, death benefit, or liquidity. Everything that you see on that screen there would be guaranteed by that $100,000 deposit. So just to quickly wrap up here before I pass it over to Mike Palatiello, most folks think about long-term care. They think about facility care only. They don't think about the 4 or 5 years that precedes that nursing home visit. So that's the loss of independence, the loss of the driver's license, the supervision needed at home, and typically that progresses to needing home care coming into the house. In some cases, that'll progress to the point where you need to go to that assisted living facility. So I think we need to help educate folks that long-term care is not just a nursing facility. And it's not just about the money of how are we going to pay for it. It's, where do I want to receive care? Who's going to be able to provide that care? If I'm relying on my family, are they aware that they're going to be my primary caretaker? Can they put their life aside? Do they have kids of their own? So, all of that kind of gets unpacked as soon as you start that conversation. So I do think it's up to us in the industry, to really be that icebreaker to say, hey, whether or not an insurance product makes sense for you today, maybe it makes sense in 5 years or 10 years, but we at least need to have this conversation. We can't just put it off because, all of those folks that are putting claims in with Medicaid today are folks that put off that conversation, underestimated how much it might cost, or thought that they were part of the 30% that would never need it. So, engaging clients early and engaging them often in that conversation, and just putting a plan together, completely, exclusive of insurance to say, well, what assets would you use to pay for a long-term care event if it was costing $150,000 or $200,000 a year? And how quickly would that unravel all of the other retirement planning that we had done? So at this point in time, I'm going to go ahead and quickly wrap up. I know we're going to leave plenty of time at the end here for Q&A, but at this point, that's how Lincoln's product works. So obviously, the applications of it, what I would talk about are most folks, when they think about a long-term care recipient, it's usually somebody in their late 70s or 80s. And unfortunately, they think about that same person buying long-term care insurance, and those two don't generally go hand in hand, right? So we want to engage clients early enough to where they haven't had that health impairment, or they haven't been limited by their mobility. Typically, folks that we're having the conversation with MoneyGuard are in their mid 50s to mid 60s. I would say that's sort of the sweet spot, but we do have some really unique options available for, the higher income earners in their 30s and 40s, where, putting a guaranteed plan in place just makes a lot of sense. They have the income and they have a solution available to them while they're in good health. The other area that we see folks moving into are folks that have in-force life insurance, that whole life policy, that UL policy, that interest rates, frankly, aren't paying much, dividends are at all-time lows. So doing those policy reviews, folks are realizing, well, do I even need this life insurance coverage that I bought 20 or 30 years ago? It has $50,000, $60,000 of cash value. Can I leverage that cash value and put it into a hybrid product like Lincoln's MoneyGuard? So a number of different areas that we can really target, but I would say that 50 to 65, 50 to 70 age range are folks that are probably seeing their own loved ones go through it, right? A 65-year-old probably has a parent that has gone through a long-term care event, or it is becoming more of a top of mind conversation. So I would say that window is really where we're seeing folks gravitate toward the MoneyGuard solution, being fully guaranteed and not having to worry about premium hikes in the future, but still getting a leveraged tax efficient product like Lincoln's MoneyGuard. So with that, Mike, I will go ahead and kick it over to you.
Hey, Mike, before we go to you, just a couple quick seconds here. If you're a money manager and you're afraid you're going to take money from the managed money that you're doing, think of the rainy day fund that most people have sitting in their checking accounts, sitting in their savings account, and talking to them about what's the intent of that money. Well, it's for a rainy day. Well, what could be more of a rainy day than having a long-term care event or a need, which will go for the rest of your lifetime? So why not leverage that rainy day fund and not, and protect the assets that you're working with? I do want to say that Main Street Planning Group is a wholesaler of many products. We focus on long-term care. We think it's very important. But some of the added resources that Main Street gives you is people like Larry Shear, who's on the line, who's a state and trust attorney, as well as Adam Flattail, who actually helps clients who are in a crisis situation, who need to find a place, who can get to a place. So having these kind of resources and working with us, we're out for your client. We're not just a product wholesaler. We're out to help your clients. And we're there for you, whether it's an insurance product or it's a legal need or it's a financial need. And I think that's our unique value offer to you as agents, is to have those resources available to you. So with that, I hand it to Mike, who's also extremely valuable resource to us.
Well, thank you, Neil. Thank you, Glenn. Appreciate everybody's time this morning. Glenn does an excellent job for us with the MoneyGuard product. It's all Glenn does is MoneyGuard. no other products. So he's a terrific resource. He's an expert in the industry on long-term care as well as competitive positioning. To expand a little bit on Neil said, wasn't part of what we're going to do today, but when you mentioned those who invest or managing clients' money, there's always a discussion in our group when we communicate with brokers who do that is, you know, hey, I have this AUM. I don't want to give up the AUM, $100,000, $200,000. And my response has always been, if you don't talk to your client about MoneyGuard and long-term care, somebody else will, and that somebody else might be managing money as well, and they may have a conversation not only on MoneyGuard or long-term care, but they might have a conversation that could put you in a competitive position on managing money. So it's really a defensive item with your client as well as good planning, in my opinion. Today we wanted to share a little bit more about how you can position MoneyGuard to business owners. The typical sale is to the individual, usually high net worth, lots of liquidity, moving assets from one pocket to the other, as Glenn was saying. But what about the corporate scenario? What can you do to position it to business owner and key employees to a business that are of value that you want to retain through retirement years? In today's competitive marketplace for high income earners, there has to be more than just the salary. You know, they have to look at the entire package of working with a company. So what I'm going to talk about, and I'm going to try to keep it as simple as possible, as straightforward as possible, as transferable as possible, to get a conversation started on long-term care to a business owner, is to talk about a welfare benefit plan for the owner and for the key employees. Welfare benefit plan meaning that it's going to provide a long-term care event funding in the event that there's a loss of 2 ADLs or cognitive impairment for that employee, and it can extend into post-retirement planning as well. So to keep it simple, let's just propose that a business owner, we're talking about a C corporation for a business owner and an employee of any business, right? If it's a business owner for a non-C corporation for tax purposes, then it's like using their own money from their capital account. So there's really not a lot of difference between them writing a check out of the company or writing a check personally for that type of business entity. But for a C corporation or for the employee of any corporation, you can propose this as a benefit. So let's suppose we wanted to provide $5,500 a month of long-term care benefits starting today and continuing through post-retirement. We can do that by providing a simply written corporate resolution that you're going to provide it for these employees at this level, and the corporation will reimburse the client for long-term care expenses up to the $5,500, the amount that they're purchasing, for 6 years for the loss of 2 ADLs or cognitive impairment. That's simple. So what's the best way to do that? By purchasing a MoneyGuard product that will match that defined long-term care benefit I just described. And we're going to use the $100,000 example, single pay. It could be also a 10 pay or other flex pay options. $100,000, we're going to ask the corporation to write a check for $100,000 of premium or deposit, as Glenn better positions, and I agree with him on that. $100,000. And from an accounting point of view, that corporation is going to debit cash because they wrote a check that went out the door from their books. But at the exact same time that policy was placed, they're going to book an asset, and they're gonna credit cash value life insurance, because technically MoneyGuard's a life insurance policy because of the death benefit over and above the long-term care element. So they're going to credit cash value life insurance of $70,000, as Glenn showed you earlier, the initial return of premium from the time you buy the contract. And if they put the vested option, so that's $30,000 loss, or a charge to earnings, a charge to the profits of that corporation in that year one. So they wrote a check for $100,000, they debited cash, they credited $70,000 in cash value life insurance as an asset, and that asset's considered liquid because they can cash that in tomorrow. Right? That $30,000 is a charge to earnings or a charge against their profits. But if they put the vesting schedule on, that at a 3% a year, that $30,000 is recovered after 10 years. So there's a charge the first year, but there's a recovery of 3% of that initial $100,000 over the next 10 years. So it's fully recouped on the books. That's important for any corporation in business that needs to post a bond. They need to have liquidity on the books. This is considered liquid. Any corporation that needs to have assets for borrowing for the bank, for their lines of credit, that asset on the books is important. So that $100,000 doesn't go out the door. Now, they don't get a tax deduction for that $100,000, but they are booking that asset. But there is a cost recovery. So now the insurance is in place. It provided for long-term care benefit of $5,500 a month for reimbursing that client, that employee, up for up to 6 years. If there was a long-term care event, the employee would pay the expense, the corporation would reimburse that expense. When that corporation reimburses that expense, that payment out is tax deductible. So the premium's not, but the benefit is tax deductible. So if they paid out the $5,500 for the full 6 years, roughly $400,000 of benefit, they would get full cost recovery if a claim happened through the future tax benefits. Likewise, if that person died before the long-term care benefit, there's a benefit that's going to go back to the corporation that's greater than the $100,000. So there's full cost recovery at death. Okay? So you have those two elements there. The employees receiving or getting reimbursed that $5,500 a month is tax-free under the welfare benefit provisions. So it's deductible to the corporation, tax-free to the individual. At the same time, this is a funded plan. They bought the MoneyGuard contract. The corporation goes to Lincoln and gets reimbursed the $5,500. That reimbursement to the corporation is received tax-free. Okay? So they didn't get a deduction up front. They were able to book it an asset eventually equivalent to what they put out. If there's a long-term care event, they get a deduction when they pay it out, tax-free to the employee, and they get reimbursed from Lincoln tax-free. So they get cost recovery on claim. They can provide this benefit beyond retirement and keep it in place and work exactly the way I just explained it. However, if they want, and they want to get out of the accounting of this and keeping track of the retired employee, keeping track of the benefit they're providing, they can transfer that life insurance policy to the employee at that point in time, if they wanted to, or they could just keep it in place, or they can terminate the plan. Those are all options to them. But if they transfer that policy to the employee, that would be considered compensation at that point for the value of the policy at the time of transfer. And that would be taxable to the employee, but deductible to the corporation as a 162 bonus. We're familiar with 162 bonus plans for life insurance. When we transfer that MoneyGuard policy to that retired employee, it would also be tax deductible to the corporation in a taxable event, but the employee can continue that coverage at an extremely discounted rate, that only the tax on that. And as Glenn was saying, less than 1% of Lincoln policies, and we've been selling this since 1988, so it's not new, have ever cashed in the contract. So once they have it, they value that benefit, and they're going to keep that benefit moving going forward. So for an employee, for the owner of a corporation. You could also do it on the spouse of an employee as well, if you so choose to, with a highly compensated group. But think about this from a family business, okay, where it's going to be generational. It's important to have that on, let's say, the father who's running the business today, have that insurance in place. And as the time goes on, that father may still be actively involved in the business, even though the children may be taking over, or they may be leaving, and there might be some drag on that individual's assets. It would be great to have that policy in place. So utilizing the corporate assets and being able to retain the asset on the books from a bookkeeping and accounting point of view makes this sale very attractive to a corporation that obviously has to have high earnings if they're paying their employees, highly compensated, and they need to have a lot of liquidity on the books for loans, lines of credit, and for bonding. Those should all be signals of, let's present a MoneyGuard policy, because booking that asset's important. I saw some mouths moving here. I don't know if somebody's on a phone or whether they had their Zoom on mute, but that's the simple story of it. It's not a complicated sale. It's very attractive. Lincoln has been very successful across the country in communicating this to businesses and successful businesses that can afford to be able to transfer assets from cash to cash value life insurance. So I'll turn it over to questions for Glenn or myself, and see if we can help anybody any further.
I have a comment, if that's okay, guys.
Sure.
Thank you, Mike, and thank you, Glenn, very much. Very informative and apropos, of course. As Neil was saying, I work with families that are looking for long-term care solutions every single day. And Glenn, there were by no means any inaccuracies in what you were saying, but I think maybe you're doing a little bit of a disservice during the selling process by not going into a little bit more detail about 2 points. And I just wanted to give you guys a little bit of ammunition if this helps. Medicaid is fantastic, okay? It's a great fail-safe program, but what it lacks relative to long-term care planning and long-term care insurance is extremely important, and I feel should be mentioned in every one of your sales pitches or discussions with your families. What it lacks is the ability to have choice. And when Medicaid is governing the reimbursement for what you need, whether it's in-home or in a skilled nursing facility, it takes out of the equation what you really want and need, because it puts the care component into the hands of third parties that are going to dictate what you're going to get and where you're going to go. And skilled nursing facilities are not what assisted living communities are. So that's important to know. And you may not get the amount of Medicaid hours that you're thinking you're going to get if that's the route you go. So choice is extremely important. And then secondly, relative to your numbers, Glenn, on $70,000 being the annual assisted living average, that's accurate, of course, but I think it's also important to dissect that a little bit and get very specific and a little bit more granular, perhaps, to the specific family you're talking about, because if you were to segregate or separate out what memory care costs would be, it's substantially higher than the roughly $5,700 a month that your $70,000 a year comes out to. Memory care on Long Island is averaging about $8,000 a month or $96,000 a year. So that could give you some ammunition to not only talk about a higher need to, or making it even more important to the family, but maybe even getting a higher sale for that policy. So just wanted to share that real quickly.
All great points. Thank you.
Those are great points. And one of the features that Lincoln makes available, where you can determine the average cost as well as the private care cost across the country by county, by state, is the website. I know we changed the name of it. Is what care cost, Glenn? Is that it?
Yeah, whatcarecost.com.
Whatcarecost.com, and you can actually put in a zip code and get the average cost of private care, assisted living, and other long-term care expenses and knowledge right there in front of your client. So
Yeah, we have it. We have it on our website. So if you go to our website and hit long-term care tab, you'll see the actual cost. And if you're looking for your parent and they're in Florida, or if you're looking for yourself and you plan on staying in New York, wherever it is across the country, you can go by zip code and look anywhere in the country and look at your costs of care. And if that's part of your decision-making in retirement, that's something certainly worth considering. Not only how you're going to be taxed, but how much the costs are going to be.
And relative to that, the numbers that you're going to be presenting on an average cost, I'm without looking at what you're looking at, I'm telling you they're going to be undervaluing or underestimating the cost, because when you look at the averages, there are many lower cost solutions available that would not be appropriate for your clients, and that skews it to the low side. So having intimate knowledge of what it really costs, I think is very valuable to you guys.
And then again, to Adam's point, as far as, when you're engaging clients in, what type of facilities, did you see a loved one go through, and tell me about that facility. So in that discovery phase, you might uncover that they do have a history of Alzheimer's. So, hey, maybe we should look at memory care costs, not just assisted living. So that was just another point.
I may want to point out just one thing, that the estimate for an average place that you would send a family member to on Long Island in a nursing home facility is closer to $15,500 a month. So you're looking at $188,000. It makes it an easier sell when you're just judging it cost today, cost in the future.
Absolutely. Any questions for Glenn or I?
Mike, I also wanted to point out that when you're doing the corporate planning, you could almost use it as a corporate handcuff as well. So a golden handcuff.
Absolutely. And you can say, if you're not here at a retirement age, whatever age that is, your post-retirement long-term care benefit is terminated.
Right. And then the company recoups its money that it put out from the MoneyGuard.
Right. And the corporate sale is not for everyone. It's got to be a successful small, medium-sized business, has good cash flow, is operating in the manner that I was describing. They can do this. And at a certain point, to attract talent, you got to give the right type of benefits. And this is one that is being added more and more to keep the talent there from moving. And we think MoneyGuard's a good solution to do it. And I don't recall in Glenn's presentation, but I wanted to emphasize, when someone buys a MoneyGuard contract, it is fully guaranteed for the life of that contract. Maybe you did mention it, but
yes,
as opposed to a traditional long-term care where those rates can change. Yes, you did, because I gave you the example. So the contracts we sold in 1988, 1990, and 2000, those are all fully guaranteed. Lincoln cannot change one provision in that. And that does give peace of mind. And the idea that you have that guaranteed benefit, you may need more than what that guaranteed benefit is, as Larry, Lawrence, and Adam were sharing. It's extremely high in our region of the country, but at least this amount has been covered to reduce the pain of paying that $15,000 a month or whatever they put in place. So something's always better about having it than defaulting to Medicaid at some point in the future. Glenn, I think there was a chat question in there, if you saw it. Inflation options?
Gotcha. Yeah. So we do have inflation options on the product that we have in New York. It works slightly different. So I just want to make sure I touch on that. We have a 3% compounding option, and that would be on the LTC benefits once the death benefit piece is exhausted. So I talked about it being a linked benefit. So you have your total pool of LTC. A component of that is your own death benefit, right? So once you go on claim, you're drawing down from your own death benefit first. The inflation coverage would kick in once that death benefit is exhausted, but we do have it available. It's 3% compounding in the state of New York. The one other piece that I want to touch on, because I did touch on the tax efficiency of it, but I have a feeling over the next few years, it'll probably become a bigger part of the story. You know, you look at programs like Medicaid and you know, the conversation around tax rates changing every 2 years, every 4 years, whatever that is. You know, a big part of that are the entitlement programs, and you know, Medicaid certainly isn't a guaranteed benefit in 20 or 30 years. So you are going to see either increasing taxes to help maybe pay for you know, those increasing claims going in there. But with a product like MoneyGuard, we talk a lot about the guarantees, a lot about the leverage for the LTC. Any benefits paid are income tax free, which is a big piece. If your alternative is self-insuring or self-funding, and you're pulling money out of qualified assets, you know, we can look at what the income tax rates are going to be on that, the capital gain taxes on that. But who knows what they're going to be in 20 or 30 years. And that's just another piece of, let's remove that one additional risk off the table. Whatever pool of benefits we're purchasing with this policy are going to be received income tax free. So that's one piece that I suspect will become a bigger part, you know, over the next few years here.
Excellent. Well, we're kind of short on time. If you have any further questions, please send me an email, give me a call, text me like you normally do, and happy to answer any questions regarding MoneyGuard, any questions regarding long-term care and life insurance. That's what we're here for. We value our relationship with Lincoln and appreciate Mike and Glenn on taking the time out to present this, because this is an extremely hot topic. It's only getting hotter. Even though companies are leaving the space, it doesn't mean that the need isn't there. The need is never more prevalent and needs to be discussed. And with that, I thank you again for showing up, and it's good to see everybody, and everybody stay healthy.
Thank you for having us, Neil.
Thank you.
Bye, everybody.
Thank you.